Hello everyone, I am Jansen C., your first presenter for Cost of Capital, Part 1. In this topic, we are going to discuss the WACC overview or WACC overview, the cost of debt, and the cost of preferred stock. What is WACC or WACC? WACC stands for Weighted Average Cost of Capital. And speaking of capital, what is capital? Now, there are so many meanings of capital, but we all know that capital is the money that we use to expand, run, or to start a business, like supplies, goods, or equipment. All of this that we use in the business needs capital. How do we obtain this fund, or how do we obtain our capital? It's either we loan from the bank, which is debt, utang, or from an investment, from investors, partners, or owners like us. Now, the question is, does capital have a cost? Of course, yes, it has a cost. Having said that capital has a cost, what is our cost of capital if it is from debt or utang or investment, which is equity? Now, what is the cost of capital if it is from debt? We need to identify that the debt itself is different from its cost or the cost of debt. Now, what is our cost of debt? The cost of debt is the interest rate charged to the company, and which is, for example, as estimated, 4.9%. This is our cost of debt. However, I prepared a computation for us to demonstrate. Here's the Excel file that I have prepared for the computation of our cost of debt. Now, the formula is interest rate times 1 minus the tax rate. Why do we deduct the tax? It is because, if you can remember, during our financial accounting class, the tax is recorded as tax expense. That's why we need to remove it. Now, to proceed with the computation, interest rate, which is 10%, move here, times 1 minus 0.30, because the tax rate is 30%. 1 minus 0.30 equals to 70%. So 10% times 70%, or the 70% of the 10%, is equals to 0.90 or 4.90%. That is how you get your cost of debt. For our computation, our cost of debt is equals to our cost of capital, which is 4.9%. However, what if it is an investment or equity? Does it have a cost of capital, or does it have a cost given that it doesn't have an interest? Equity. Now, since the capital came from the owners, investors, and partners, they are expecting a return, which is, for example, 10.30% dividends by the end of the year. However, this is just an estimation because the computation for cost of equity will be tackled during the CAPM, or Capital Asset Pricing Model. Let me provide you an example of a computation. In this Excel file, I have here the computation of cost of preferred stock, which can be considered as cost of equity. For the cost of preferred stock, the computation would be cost of preferred stock is equals to DP, which is dividends per share, which is the 10 pesos, and the stock price, which is the 97 pesos. Dividends per share divided by the stock price. Now, to compute 10 divided by 97.50, which is the current price, it's equals the dividends per share, which is stated here, divided by the 97, which is also stated here. You have 10.26%. That is your cost of equity or cost of preferred stock. After the computation, we know that the cost of equity is equals to cost of capital. And now we all know that the cost of capital for debt is the interest, which is the 4.9%. And the cost of equity or the cost of capital for the equity is the expected return. Now, the question is, what if the cost of capital was taken from both debt and equity? What is your cost of capital? This is the time that we are going to use the weighted average cost of capital, which is WACC or WACC, since our capital came from debt and equity. Here is how are we going to compute. WACC is equals to equity divided by the total capital times the cost of equity plus D divided by, or the debt divided by the total capital times the interest times 1 minus the tax rate. Let me demonstrate this in Excel so that it will be easier for us. In this Excel sheet, we are going to compute the WACC or the WACC formula calculation. Up here, instead of making it by paragraph, I break down the data so that it will be easier for us to understand. So, WACC is equals to E, which is the equity, divided by the V, or the cost of capital, times the RE, or the cost of equity, plus the D, or the debt, divided by the total capital, or the V, times the RD, or the interest, times 1 minus the TC, or the tax rate, because we are going to deduct the tax. So let's go to the computation. WACC is equals to equity, which is the 300,000, and then divide it by a million, which is the total capital, times the 0.20, which is the 20% cost of equity, plus the debt, which is the 700, divided by 1 million, which is the total capital, times the 10%, which is the interest rate, times 1 minus 0.30, which is the tax rate. So 300 divided by 1 million equals 0.30 times 20%, we will have 0.06 or 6%. Let's proceed. D, or the debt, which is 700, divided by a million, which is the total capital, there, times 0.10, which is the interest, times 1 minus 0.30. So 700 divided by 1 million equals to 0.70 times 10%, which is 0.10, times this is 1 minus 30 equals to 0.70. Oops. So 0.70 times 0.10 equals to 0.7. 0.7 times 0.70. I mean 0.07 times 0.7 equals to 0.049 or 4.9%. Now we are going to add these two. Plus 4.9%. We have 0.11 or 11%. Let's say we have a new bio project. As per computation earlier, we have 11% WACC or weighted average of cost capital. And our new bio project expects 4% earning. Is it a good or a bad investment? Of course, it is a bad investment because we are a loss of 7%. Well, for example, our WACC is 11% and the new project expected earning is 21%. Is it a good or a bad investment? Of course, it is a good investment because we are gain of 10%. Or we gain 10%. That is how we use the WACC. That is all for my report. Thank you for listening.